Okay, I'm going to go ahead and call to order the Retirement System Board of Trustees meeting for Friday, January 22nd, 2021, called to order at 8:03 a.m. Start by a roll call vote. As a reminder, we will be mentioning where we're located. So I'll start with myself, Lee Colick. I'm in Royal Oak, Michigan. I'm the chair. Go to Brett, please.
Brett Nelson, I'm in Troy, Michigan.
Thank you. Brett is the vice chair. Let's go to Kyle, trustee.
Kyle Dubuck, I'm in Royal Oak, Michigan.
Thank you. Let's go to Commissioner Monica Hunt, trustee.
Monica Hunt in Royal Oak, Michigan.
Thank you. Let's go to City Manager Paul Brake, trustee.
President Royal Oak.
Thank you. Julie Rudd.
Present.
Thank you. She is the Board Chief Administrative Officer, Board Secretary, Board Treasurer, also Finance Director. Lisa Genord, Administrative Assistant, Pension Technician.
Present.
Thank you. Tom Michow, Board Attorney with Van Overbeek, Michow, and Timoney.
Present.
Thank you. And Terry Gerlich, Investment Advisor with SEI.
And present.
All right, thank you. Brings us to public comment. Carol, are you with us? Do we have public comment?
There's nobody in the audience, so
Okay.
you are all set.
All right, sounds good. Thank you. I'm going to make a motion that the board approve the agenda for January 2020 or 22nd, 2021.
Brett supports.
Brett supports. All in favor? I'm a yes. Monica?
Yes.
Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
All in favor? Passes. I'm going to make a motion that the board approve the minutes for December 18th, 2020. I have support.
Brett supports.
Brett supports. All in favor? I am a yes. Monica?
Yes.
Brett?
Yes.
Kyle?
Yes.
And Paul?
Yes.
Thank you. It carries. Under adjustments, applications, and benefits, we have Chad Adam, former officer with the police department. Requests withdrawal of employee non-vested contributions and interest from the plan amounting to $1785.67. Separation from service was effective August 30th, 2019. We have Caitlin Smaltz, officer with the police department, requests withdrawal of employee non-vested contributions and interest from the plan amounting to $13,638.48. Separation from service was effective September 29th, 2019. Under benefits, we have David R. Cummins with the fire department. Fire bargaining unit, 28 years and 2 months of service credit. Retirement date of October 27th, 2020. Selected option D, 75% to surviving spouse, 89/2019 gross monthly benefit with withdrawal of contributions and interest of $119,233.94. I'm going to go ahead and make a motion that the board approve the adjustments, applications, and benefits as listed. Is there support?
Brett supports.
Brett supports. All in favor? I am a yes. Monica?
Yes.
Brett?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you. With that, I'm going to turn it over to Terry for investments.
Hey, thanks. And I'm going to try to share my screen here. So I'm not sure if and I am enabled. Okay. Can everybody see that?
Yep.
Good.
Okay, great. All right. Well, it's always nice to be with everybody, and particularly ending a year where we made money. It's always nice to talk about that than talking about money we lost. So why don't we get right into it? I'll focus most of my comments on the year as opposed to the quarter. If I can get this, go to the next page. There we go. As you can see on the right-hand side, really focusing on the 1 year, the gray bars you can see it ended up being a very strong year in the markets. Who would have thought, going back to earlier in the year when we were looking at economy is similar to a Great Depression and big sell-off in the market in the first quarter. We've seen the real big rebound in the latter part of the year, as we've talked about all year. It really is all related to the COVID and then the solution for COVID. So earlier in the year, the pandemic caused quite a bit of weak economic and market weakness. But as we talked about, the market would be looking forward to recovery in 2021 and beyond, and on the premise that there would be a solution to the COVID pandemic. And indeed, not only did we see the markets begin to do better in the summer, but when the COVID vaccine announcement was made in the fall, we saw a significant rally in the market take place. So as you can see, the large cap marketplace, the Russell 1000, the S&P are both up about 21% for the year. Small cap pretty similar at about 20%. International markets ended up the year up fairly strong, but they were behind the U.S. recovery earlier in the year, and as you can see in the fourth quarter, actually started to rebound very, very nicely and actually outpaced the U.S. markets. So posted some pretty strong numbers, particularly the emerging equities. And even on the fixed income side, we saw some very strong performance even in investment grade bonds as interest rates declined over the course of the year. That helped to boost the value of our investment grade bond portfolio, and the market ended up about 7.5%. And then finally, we have an allocation, as you know, to high yield bonds, emerging market debt. Both of those tend to be a little riskier asset classes in terms of volatility, as opposed to investment grade fixed income. Got hit hard in the first part of the year like equities, but have since started to come back nicely. So all in all asset classes across the marketplace up, and you're able to participate in that rally across those asset classes. We are indexed in U.S. Stocks, but what's been interesting there is there's concern about, given the strong rally, about whether the market's overvalued. We think the bigger story is that we're seeing a rotation of leadership in the market, which is healthy. There is clearly areas of the market, the big cap technology stocks that have been the real winners the last few years are at very high valuation levels right now. But what we're seeing is a rotation into other areas of the market, finally, that are more reasonably valued, generally called value stocks, lower PE ratios, not growing like the high tech mega cap stocks, but more cyclically oriented. And as investors are looking to an economic recovery, they're expecting an increase in corporate profits, and so a real rotation to those economically sensitive areas. So we think that's healthy for the marketplace to see that rotation. We think there's still opportunity for the market to advance. International markets, I won't spend much time on. Similar story here, and just as in the U.S., throughout the world, it really is a story about the COVID vaccine, and markets internationally followed a similar pattern to the U.S., not surprisingly, as we had this global pandemic. What's good to see, and what we think may continue, is that we actually may see the non-U.S. portion of the portfolio begin to exert some leadership here as we go into 2021, 2022. As worldwide economies recover, valuations are a little more reasonable in some of these markets. And finally, we're seeing a weakening of the dollar. And as the dollar weakens, that tends to be bullish for the non-U.S. stock market. So we think that what we saw in the fourth quarter has some potential to continue. We might see international markets do even better than U.S. markets as we go forward. On the fixed income side, it really was all about interest rates for the whole year. As you see on the left-hand side, you look at where rates were a year ago on the dotted line at the top, and then where rates came down as the year went on. As you can see, we were already at very low interest rates entering the year, but rates went down even farther, particularly as a result of not just the slowing of the economy, but also very aggressive monetary intervention with central banks around the world cutting interest rates. And you can see the short end of the curve there. You can see how low rates are, pretty close to zero, as central banks are keeping short rates, which they control directly, keeping short rates close to the zero bound in order to help support the economic recovery as a result of the damage caused by the COVID vaccine. So as rates come down, prices are going up, and we benefited from that. Secondly, on the non-treasury sector of the marketplace, on the right-hand side, spreads were all over the place in the quarter, and we've discussed this as the year went on. Early in the year, spreads blew out significantly, causing a sell-off in the non-treasury sector of the marketplace. But then we saw a recovery as time went on. So you can see, the green bars, how wide spreads had gotten sort of at the end of the summer, but a very strong recovery. Spreads contracted in the fourth quarter as investors gained confidence, and as they gained confidence, we saw the prices of corporates, asset-backed, mortgage-backed securities strengthen considerably in the fourth quarter. Pretty much back to average, long-term averages, in some cases tighter than longer-term averages. So the big rally is probably over, and we'll be happy to clip coupons in 2021. But I know I said that last year too, where I said where rates are already so low, you can't expect much out of fixed income. We ended up with a strong fixed income market, so one never knows for sure. So I'm not going to spend too much time on this slide. It's really self-evident, as we've talked about all year. The market and the economy have all been dependent on the pandemic, and now hopefully the solution to the pandemic with the vaccines having been developed. So we're hoping for clear economic growth or strengthening growth as we go into 2021. And we've also had a number of other uncertainties get pushed out of the way, which is always helpful for the market. The US elections are over with, and the Brexit deal has happened. So the markets hate uncertainty. So things are looking much clearer going into 2021, and that's good news. The bad news, if there's any, is that markets have run quite a bit. As I say, there's still opportunities for certain areas of the market to do well, but valuations are full. And the biggest issue for 2021 is likely to be a focus on inflation. The central banks are staying very, very accommodative. They want inflation to be a little bit higher than the very low levels it's at, and they're willing to let that inflation rate rise a little bit before they start taking the punch bowl away and start raising rates. So there's a chance that we can see some more inflationary pressure throughout 2021. A little bit is not bad, but if it starts to rise too quickly, that could cause some volatility in the markets. That's probably the biggest risk or uncertainty out there that the investors will focus on as we go through the new year. And then, unless there are any questions, here's how the portfolio looked as of the end of the year. You can see the target allocations as opposed versus where we are in terms of actual allocations. Again, as I always point out, well diversified by asset class, and of course, with the multi-manager structure that we have in place, you're well diversified by managers within each asset class. So a lot of the diversification built into the portfolio. Generally in line with targets. Overall, a little higher equity exposure, as you can see. 63%, a little over 63% versus 60% target for equities. And that's really a result of that'll continue until we get the private equity portfolio invested. As you can see farther down in the alternative section, GPA 5, the private equity fund target is 5%. But the money, it takes a long time to get invested in the private equity space. And so just really beginning to see investment there. So managers will continue to pull down capital over the next couple of years, next few years, and begin to invest that money. But it is a multi-year process. So we'll be underweight for a while versus target in private equity, and that money is mostly up in the equity area of the portfolio. So you'll tend to see that little bit of an overweight there until we get more invested. But otherwise, pretty much in line with targets. In terms of performance, it's a page I'm very happy to talk about this meeting. As you can see, focusing on year to date, gross basis portfolio is up about 16.7%. Net basis about 16.1%. So very strong returns for the year. And nice to see on a relative basis versus the benchmark, managers adding value. As you can see, the benchmark portfolio benchmark was up 14.8%. So very strong absolute and relative returns. And translating that into dollars, it's always nice to look down and see that we made a little over $24 million last year. And again, who would have thought, as we were meeting in April, looking at the damage from the first quarter, that we would end up with as strong as a year as we did. So 24.4 in terms of gains. There was 8.5 million cash flow out to pay benefits. But it leaves the portfolio value at just under $175 million as of the end of the year. And then breaking down by asset class, looking at performance, again, focusing more on the year-to-date numbers. I will point out, though, that the quarter was fourth quarter was very strong, and that's really as a result of the COVID vaccine announcement. So you can see how much ground was made up in the fourth quarter. For example, U.S. equities up 15.8% in the quarter. So very, very robust quarter. So for the year, it ended up total equities up 19%, U.S. equities up a little over 22%. And again, we're indexed in the U.S. equity market, so pretty much matching the benchmarks there. And then beyond that area of the portfolio, we have active management and a multi-manager structure. And as you look at the year-to-date numbers, strong on an absolute basis, and happy that all the active strategies were ahead of their benchmark for the year. So very pleased with how the managers ended up navigating the year. So world equity, the non-U.S. equity portion of the portfolio up 15.5%. That's broken down into two strategies, as you see. World equity ex-U.S., which is a combination of developed and emerging markets, up 14.9%, comfortably ahead of the benchmark, which was up a little over 10%. In fact, I'm going to make this a little bit bigger so you can see that. I don't know if that helps. And then emerging market equities, specialists in that particular area of the world, up a very strong, almost 19%. And again, ahead of the benchmark there, as you see. Fixed income ended up with very strong returns for the fixed income space, up almost 10%. And core fixed income in particular ended up a surprisingly 9.6% return. Very good relative to the benchmark, which is up 7.5, but also just very good on its own, being up almost 10% when we started the year with such low interest rates, and yet we were still able to see a very robust return as rates went to historic lows. That's the good news. Bad news going forward is now rates are at historic lows. It's likely that rates are going to probably move a little higher here, which will be a little tougher go for core fixed income. And as rates rise, that's going to tend to take away some value. But it's an important diversification tool to have. We only got about 18% of the portfolio there. So even if rates do rise, we're pretty well protected with everything else we have in the portfolio. Emerging market debt, as you can see, with the strong recovery in the fourth quarter, really undoing the damage from earlier in the year, ended up emerging market debt fund ended up 5% for the year. Again, good job versus the benchmark, which was up 4%. And high yield bonds up 6.3%. And really making up ground, as you can see, really made up all that ground in the fourth quarter, with the fourth quarter up about 8.3%. So low quality bonds certainly suffered in the uncertainty earlier in the year as investors expected default rates to increase. They did increase, but not to the extent that people expected. And we're seeing a nice recovery in that space. And then core property, more of a quiet year in the property real estate section of the marketplace as vacancies rose as a result of the pandemic. But on a relative basis, held its own, up 2.1% for the year, up about 1% for the fourth quarter. We actually saw some losses in the summer as those vacancy rates spiked, but on a relative basis, the managers held their own. And it was very good to see structured credit up a little over about 5.6%, really making up a lot of ground from, as we this was the area of weakness in the portfolio earlier in the year. It's a very volatile section of the marketplace because it's a very illiquid part of the marketplace. But we saw a very, very strong recovery. We thought earlier in the year that this section of the marketplace was oversold, and that we tended to see this pattern in the past as well, that when weakness occurred, this old classic, if one area of the market was catching a cold, structured credit would tend to catch pneumonia. And indeed, that's exactly what happened earlier in the year. Because of that illiquidity, prices tend to move quite a bit in either direction. But as investor confidence was regained in the latter part of the year, we saw that indeed that market was oversold and was up 17.7%. That number is actually only through November because it's reported on a 1-month lag. So that's really the 3 months ending November. December was even stronger. It was up about another 10%. So you'll see that in the January number as well. So good, strong recovery there. Very pleased to see that as well. So overall, very happy with how the portfolio navigated the year. Very happy with the result, and finally happy with how the managers added value. And then again, this is the PE report, which we'll continue to provide every quarter. Again, PE is reported a little differently. In order to analyze it, it's important to look at how much money is actually committed, how much is invested, and then I'll talk about performance in a second. So for example, you see we committed $3 million. We've funded, we've selected all the managers now. Money is fully committed to all the private equity funds. The private equity managers are going to take, like I say, 2, 3, 4, 5, in some cases 5 years to draw down that money. But we've got 116,000 invested right now, so there's another 2.8 to invest. And as you go to the right, not really meaningful yet, but will be as we go forward. There are 3 measures of performance: DPI, TVPI, IRR. What are we talking about? DPI is distributions for paid versus paid in. Ultimately, with private equity, it's how much money did I put in and how much money did I get out. You haven't seen any distributions yet. We've put a little bit of money to work. That will tend to grow in the second, third, fourth year, and then certainly going forward, it tends to ramp up over time. And then what's the total value to the paid in? So I put in $1 and it's worth $1.06 right now. And IRR is a better measure of performance than what you see it's called internal rate of return. That's the measure we use when we talk about performance and evaluate performance in private equity. And right now you're compounding at about a 9.1% return. So strong start. Usually you don't see that kind of number early in private equity. Sometimes you see losses in the early years and as the money's invested. But actually off to a very good start. But again, it's only $100,000. Don't want to dwell on it too much yet, but this will become more meaningful as the year goes on. And then in the appendix, I'll just point these out quickly since it's year end, just to remind you. For example, you look at world equity. It shows each of the strategies that we use, in this case, the equity strategies, and you can see a listing of the managers. So under world equity ex-US, down towards the bottom left-hand side, you can see each of the managers that are managing a portion of that portfolio. And each manager, we select managers so that they have different styles, complementary styles. We cover all the different areas of the marketplace with specialty managers. So we've got fundamental managers, we've got quantitative managers, we have value managers, growth managers, momentum, all the principal styles in the marketplace to provide that diversification. And then, and same thing, you see the list for fixed income managers. And then in the back, I'm not going to go through each one in the interest of time, but I will point out for your review, especially as we end the year, is a breakdown of how the managers contributed to performance. So it's a measure of excess returns, relative returns. So as you can see at the top, how did the fund do? Up over 4%, it's 4% over the benchmark. So it's a relative return, so excess return. And then you can see which manager added or detracted value as you look down the list. And in parentheses by each manager's name, you see how much of the portfolio that they are managing. So AB, Alliance Bernstein, managing about 20% of the portfolio, slightly down for the year, but good return in the fourth quarter. And then you see a few at the bottom there. Zero, why is that? They don't show a quarter's return. Those are managers that were there for part of the year, but we had terminated them at some point during the year. So, BlackRock and Earnest Partners are now at 0%. We had terminated them earlier in the year. So you only see their contribution for that period of the year in which they were actually managing the money. So again, I won't go through each of these unless there's a question, but I think it's worthwhile to at least take a glance at this as we end of the year to see how the discrete portions of the portfolio have been working. So with that, I will shut up and ask if there are any questions.
Thank you, Terry. First of all, great job. Excellent year, I agree. Much appreciated. I was curious in your experience, following an election year, is there anything that we should be anticipating?
Yeah, that's a good question. There is obviously a change of control in Washington. We've often talked about elections in the past where in many cases, I think the answer has been, well, we have divided government, so we don't think there's going to be too much change. But now we have control of the House, the Senate, and the White House all by the same party. So there will be maybe more policy change than would otherwise occur. But we'll also point out, though, that the Senate is very evenly divided, 50-50. Democrats control, obviously, because the vice president, as president of the Senate, is the tiebreaker. But it's going to require compromise and negotiation to pass things, even without the filibuster, if that were to go away. The Democratic Party is not monolithic. There's quite a diversity of view. And so it's unlikely that in every policy there will be unanimity. So it's going to take some negotiation. But having said that, there probably will be more policy change than usual. There might be tax increases somewhere along the way in the next 2 years. I don't think we're going to see it in 2021, given the state of the economy. But eventually, There'll be deficit discussions. There'll be talk about some of the corporate tax cuts that occurred on the prior administration. We could see some increases there. Corporate tax increase is going to have some impact on the market in terms of lowering corporate profits, but we don't see this as a significant event in terms of the direction of the market. In fact, history will tell you that markets often do very well under Democratic administration. Don't think that'll be controlling. The big issue will be more around how strong the recovery will be, and whether with that, in particular, whether that will lead to inflationary pressures. That'll be the number one issue.
Okay. Thank you. I appreciate that. Does anyone else have any questions for Terry? I'm going to make a motion to receive and file.
Brett supports.
We got support by Brett. I'm a yes. Monica,
Yes.
Kyle,
Yes.
Paul.
Yes.
Did I do Brett? Did I get Brett?
Yes.
Okay. All right. Thank you. All right. That brings us to legal. I will turn it over to Tom.
Thank you, Mr. Chairman. The sum and substance of my legal report today is an update on the Open Meetings Act. Once again, we've talked about this repeatedly over the last few meetings. Really, the change that has been made from a legislation standpoint is the act has been amended to extend the ability for board meetings to have a virtual participation by trustees through the end of the first quarter. So you will not need a specific exception to participate via Zoom or other teleconferencing functions. But come April 1st, future meetings will need to have one of three reasons, as we've discussed: military, health, or a state of emergency in existence in order for trustees not to be required to physically be present at a meeting. And with that, that's the only change we have today, is that it's, the recent business as usual will continue in the near term here. And if you have any questions, I'd be happy to address them. Otherwise, my recommendation would be is to adopt the memorandums as presented on your agenda. Thank you.
Sounds good. Thank you. Does anyone have any questions for Tom? I'm going to make a motion to receive and file. Is there support? Brett supports. Thank you. I'm a yes. Brett?
Yes.
Brett is a yes. Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you. That brings us to other. Julie, we have the revenue and expenditure. I'll turn it over to you if you'd like.
Thank you. Good morning. This is provided in accordance with the ongoing policy that the board has that allows me to authorize payments, monthly and getting the various benefits paid and the retirement board's vendors paid as well. So the ongoing policy requires that I provide the line item detail that was audited in our last audit, which ended November-ish, and then our CAFR was presented to the City Commission in December. I think it was the second meeting in December. So each January, I provide the line item details behind those numbers that were audited. And they're presented here relative to the original budget and the amended budget. I don't believe we changed the original budget, but in the 6/30/2020 line item, you'll see those actual revenues and expenditures. I won't go through them all, but if anyone has any questions, I'd be happy to answer.
Okay, thank you. Does anyone have any questions for Julie? All right, I will go ahead and make a motion to receive and file.
Brett Sports.
Support by Brett. I am a yes. Brett,
Yes.
Monica,
yes,
Kyle,
Yes.
Paul,
Yes.
thank you. Anything else, Julie?
Not on this item. Thank you.
Okay. You want to go ahead and move forward to the Form 5572? Or is that all just receive and file?
Is that what's next? Is the SAR next, the summary annual report? Or we just have them in a different order in the back?
We're just in a different order. We have both. Whatever you prefer is fine with me.
Yeah, we can briefly just mention the Form 5572. I'd just like to point out, that was filed with the state. This is the retirement board's form. There's also one you'll see on the other agenda momentarily when we get to that meeting. But I just want to point out that we have a funding ratio of 61.5%, and the trigger amount is 60%, so it's very close. In addition, there's another percentage that the state looks at, and it's on line 28, all systems combined, ADC, governmental fund revenues, and the trigger point is 10%, anything over 10% on that. So if we have a combination of less than 60 on the funded ratio and then over 10% on line 28, that triggers the underfunded status. That's defined in PA 202 of 2017. So I just want to point that out on the retirement side. And then the SAR is receive and file, and as soon as the board approves that, we will distribute that by way of departmentally. We will send 1 or 2 copies to be posted on the employee bulletin boards. That is the plan, rather than distributed to all members. That's what we've done in the last few years, and I just want to make sure that's still acceptable to the board. That again, we just hand out a couple copies to each department and ask that they post them on their employee bulletin boards.
That's worked well at the DPS. I can vouch for that. No complaints here. So at what point do we address how close we are to being underfunded? I know we've talked about it in years past, but when is that something we need to set up to specifically discuss, or how? Tom, go ahead.
Chairman, if I may,
Yes.
Other than you address it every meeting when you talk about the investment performance, you generally will talk about the asset liabilities discussion with your actuary at least once a year, if not more, if they come in to talk about GASB and other reports. So that's really when you would talk the next actuarial valuation or experience study discussion with your actuary. You could bring up the liabilities. Other than that, those are the things that the assumptions are what are reflected in your numbers, but your performance on an investment is something you're continuing to monitor on a day-to-day, month-to-month, quarter-to-quarter basis. So I don't know when the actuary is coming in next, but that would be, as you have in the past, a discussion item to review.
Sounds good. Thank you.
Lee,
Yes.
I think, was it just last year or was it 2 years ago that we reestablished our anticipated rate?
I can't remember. That's what I was trying to go back on. I know that we had gone back we had discussions a few times about how much change we should make.
Right. And I remember, we dug in on that discussion pretty well. And I remember us talking about, the point that we revisit it at certain intervals is that we're not responding to the market in real time, but looking at the smoothing over several years and then making making those strategic decisions at strategic intervals. So it's been a weird year, and we ended up making money anyway. So hopefully this year adds to our 3-year smoothing. I mean, I see Julie's face that we're probably gonna have to make an adjustment in the future, but at the designated intervals, right? Not like in real time so we're not just responding to the market as it's happening, but we do our look back and then make that decision. But I guess the question I have is, the shortfall is projected out, over time, right? As folks are receiving their benefit. So, I mean, how far out do we have to make the decision before there's an actual impact on benefits, right? As long as we're making the right decisions to fulfill our obligations in time to fulfill those obligations, that should be our priority, correct?
Yeah, Mr. Chairman, if I could also add, I mean, Kyle's comments, his perspective is correct in that this is long-term. You generally will look back at your assumptions every 5 years as what they call as an experience study to see if your assumptions that you thought would happen actually played out correctly. And then those assumptions are adjusted. So as well as your assumed rate of return numbers are something that are smoothed as well. So it's, over I think a 4-year period, you're smoothing your investment performance so that you're not fluctuating on a quarter-to-quarter basis, short-term performance that would impact the funding level and the contributions in the system. So I think if you look back at the open, the amortization period you're looking at, that if you meet your assumptions and you make the payments, that over the long term, and I don't remember off the top of my head your amortization period, if it's 20, 22, 3, 4 years at that point, but it's like a mortgage. If you make your mortgage payment, small increments, you'll get to the objective at the end of the time period, but it's not a get it done in the 1 year adjustment. It's a long period of time. And so your system has experienced some of the challenges that others municipalities have as well, with the assumptions being your mortality tables, people are living longer. You adjusted your assumptions to meet that expectation for the next 30, 50 year time frame, and that impacts your funding level today. So it's the kind of perspective that this is very long term, not 3 to 5, but more 30 to 50 years time frame here that you're working with. So these are points that, as I said, you're gonna need to discuss with your actuary, and at some point you'll make adjustments based on your experience in the projections, and it will have it will have impacts, but the idea is to smooth out those impacts over periods of time.
Does this, I mean, are we in line with what you're seeing on other boards? Is it fairly common to be within a few percent of?
Yes.
Yes, it is. Okay.
Yes. I mean, the point that I think boards and actuaries have made is that you want to be on a trajectory going in the right direction up to 100%. And so that sometimes there's a short-term fallback, but in the long, in the long run, you want to continue to be making progress towards 100%, but you don't have to get to 100% today. You have to, these are long-term commitments. These are long-term payments to your retirees. Your retirees are going to get monthly benefits for 20, 30 years. You don't have to have all the money right now to make those payments. You just have to have a plan to make sure that commitment can be satisfied over the period of time that you're looking towards. So yes, it is something that you discuss and monitor and manage. And it's very common that plans are in the 60, 70, 80 range. It's very uncommon that systems are closer to the 90, 100% range.
Another question, does the fact that we are partially open and partially closed, does that hurt us?
It's not a hurt categorization. It's a different timing. So
Okay.
the fact that you're closed for a part is that you have to make payments to make sure that those obligations are paid sooner. If it's an open system in that you have new members coming in, there's always new members funding for future members. You have a longer time frame. to make those commitments.
Yeah.
So it's just a different, it's a different way of funding and a different way of meeting your obligations and a different time frame. But it's still a long-term time frame. It's still not it's not a 3 to 5 time frame. It's, like I said, it's a 30-year time frame.
Okay, so being at 61% is reason for concern, but not reason for panic.
Correct.
Okay.
And the other thing, just to point out, is even if you fall below that 60%, the requirement would be with the Municipal Stability Board is that you come up with a corrective action plan. And so the corrective action plan that the city or the municipality and the unions would come up with would just be a plan to get moving back in the right direction. And that plan is to get you back in that direction above 60%. And they give you 20 years to get back above 60, not 20 years to get to 100%, but they give you a long time frame to get you back. So that gives you a perspective of the time frame, is that even if you dip below 60%, that is some issue that you need to be aware of, but you don't have to get right back to big 60% the next year. There's a process and a program that you work through to get yourself back on track.
Okay. Thank you. Julie, you had something?
I was just going to mention, when the actuary report was brought to the city commission, I believe it was the last meeting in December, what we do annually is ask that they resolve that the required contribution in the actuary reports for that year are put in the budget in the upcoming year. So the resolution that was just passed was a requirement that $8.6 million, which is the annual required contribution determined by the actuary, is actually put in the budget for next year and actually contributed. And the auditors audit that as well. And what that is the plan to get to 100%. And for the general employees, that's over an 18-year period. And on the police officers, or police and fire, it's 23 years. So because they're an open plan, that amortization period is longer. To me, that is the plan to get funded, because using the assumptions and assuming the assumptions are correct, at that point in 18 years and 23 years, we will be fully funded.
Okay. Perfect. Thank you for that. Does anyone else have any questions or comments on the?
I'm just trying to remember so I can set my expectations. I seem to remember Terry providing us with something that showed that over the next 10 years, we essentially, our median expected rate of return, we don't expect to hit our hurdle rate over a 10-year period. And I understand this isn't a 10-year game. It's a 20, 30, 50-year game. But is my memory correct that if he's right, it would almost seem inevitable at some point in the next 10 years, we're going to fall below that 60%?
Yes, I wouldn't say inevitable, but what we showed you was that the median expected return over the next 10 years will be less than, fairly significantly less than 7%, closer to, I think it was more like 6. That's the expected return. But remember, as we were showing you that, there were a range of outcomes. There's a 50% chance that you get a greater return. There's a 50% chance you get a lesser return. So that median return, you're right. You can expect that more likely than not, you will generate a return less than what's required. And that'll show up in your as an actuarial loss, and that would tend to increase your unfunded liability, which would then have to be amortized. Again, though, to what Tom was referring to, though, I think it's very important to also recognize is that the time frame for funding this system, or paying out benefits anyway, it's a time for paying out benefits. It's not 10 years. There are benefits that are going to be paid out 30, 40, 50 years from now. And ultimately, the goal is to make sure the money's there when it's time to pay the benefits. So along the way, there will be periods where there will be stress, where there will be stresses that will cause the unfunded liability to increase. It's likely we're going to be in that period for the next 10 years. Now, again, we talked last year, we talked about that, and and said that's the expected return for the next 10 years. Well, the first year of that 10-year period was certainly a lot better than 7%. But it's unlikely we're going to have that benefit over the next 9 years.
Okay, thank you. And Julie, was one of the points that you were making was that if we were to fall below the 60 and then we're required to come up with a plan, were you saying that we already have a plan in place?
Yes, I would say
Okay.
that would be our plan.
Okay,
That would be my response to the state of Michigan.
right. Okay, I agree. Sounds good. Thank you. Did anyone else have any other questions, comments, or concerns regarding the Form 5572?
Just one final comment, if I could, just to, again, put it in perspective. Julie, did you say 8.6 million is the budget number, contribution appropriation?
For fiscal year, yeah, beginning July 1, 2021.
What is it? Sorry.
Fiscal year beginning July 1, 2021, it is 8.6 million.
8 point, right. So what would happen is if, say, we generated a 6% return rather than, say, 7% return over the next 10 years, that 8.6 will be a different number. It might be, depending what the shortfall is, you have to amortize the shortfall. It might be 8.7, 8.8, 8.9, 9 million. That's the way it'll show up in terms of dollars and cents, is that there will be pressure to amortize that loss over a period of time, and you'll see your annual appropriations being higher than planned. Well, it's not going to go from 8 to 16. It might go from 8 to 9 or whatever, depending on what the shortfall is.
Okay. Sounds good. Thank you, everyone. I'm going to make a motion to receive and file Form 5572. Do I have to support?
Brett supports.
Support by Brett. I'm a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you. Julie, for the SAR report.
Yeah, I just want to make sure that the distribution method is still satisfactory to the board, that we don't send out to all the individual members. We just post on the website, and in addition, the employee bulletin boards.
All right, sounds good. It was good with me. As long as nobody else has any complaints, I'm going to make a motion to receive and file. Is there support?
Brett.
Support by Brett. I am a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you. Let's go ahead and set the date for the next meeting. Does February 19th, that's a Friday, 2021 at 8 a.m., does it not work for anyone? Good, everybody? Brett, good?
I'm good.
All right, thank you. That was easy. Date of the next meeting has been set for Friday, February 19th, 2021 at 8 a.m. I will make a motion to adjourn. Is there support?
Brett.
Support by Brett. I am a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you, everyone. Meeting is adjourned at 8:56 a.m.
Thank you. Take
Thank
care,
you, Terry.
everyone.
Have a good month. Does anyone need a break before we jump into the retiree healthcare? I call to order the Retiree Healthcare Investment Board meeting for Friday, January 22nd, 2021, called to order at 8:57 a.m. First, we have roll call. Start with myself, Lee Colick, Chair, Royal Oak, Michigan. Next is Vice Chair Brett Nelson.
Present from Troy, Michigan.
Thank you. Commissioner Kyle DeBuck, trustee.
Present from Royal Oak, Michigan.
Thank you. Commissioner Monica Hunt, trustee.
Present from Royal Oak, Michigan.
Thank you. And City Manager Paul Brake, trustee.
President Royal Oak.
All right, thank you. We also have Julie Rudd, Board Chief Administrative Officer, Board Secretary, Board Treasurer, Finance Director.
Present.
Thank you. Lisa Genord, Administrative Assistant, Pension Technician.
Present.
Thank you. Tom Michow, Board Attorney.
Present.
Thank you. Brian Green, Investment Advisor.
Present.
All right, thank you. Brings us to public comment. There is none. I'm going to make a motion that the board approve the agenda for January 22nd, 2021. Is there support?
Brett Sports.
Brett supports, thank you. All in favor? I am a yes. Brett,
Yes.
Monica,
Yes.
Kyle,
Yes.
Paul,
Yes.
thank you. I'm going to make a motion that the board approve the minutes for December 18th, 2020. Is there support?
Brett Sports.
Thank you, Brett. I'm a yes. Brett,
Yes.
Monica,
Yes.
Kyle,
Yes.
Paul,
Yes.
thank you. Brings us to investments. I'm going to turn it over to Brian Green.
All right, touch on a couple things here briefly. I promise you everything we're talking about today is good news. So I'm going to start with a couple of quick hits from a fact standpoint. It's this time of year, we always kind of look back and reflect upon 2020. And I know for me, one of the things I always look at, and this is to kind of start a little tongue in cheek, is, did I use my time as well as I thought I did in 2020? And to be honest, with this pandemic and small children in the house, we probably watched a little bit more TV than we would have in years past. But then I saw this statistic come across and I immediately felt better for myself. As U.S. Citizens, we collectively watched 952 billion minutes of The Office last year. That equates to 108,000 years. So last year, we collectively streamed 108,000 years worth of episodes of The Office. You see the list here, the top 15. When I saw that statistic, I immediately felt better about how much the TV was on in my house, just as we worked through remote school and pandemic parenting and everything else. But I just wanted to start with that just as a little bit of a lighthearted piece. I thought that was an interesting statistic that had come across my desk a couple days ago. Second piece, let me grab this here. Lee, this was one of your questions earlier, just touching a little bit more on Terry's comments. So what does this mean from we've got a leadership change in the White House. We've got a bit of a change in leadership from a House and Senate standpoint. What does that mean for the markets? So this is looking at the S&P from 1953 to present. The average return on a calendar year basis over that time period is 12.3%. But if we sit with a Dem in the White House and a split Congress, the average return has been 16%. If we sit with a Dem in the White House and a Republican-led Congress, numbers get a little bit better. But kind of the moral of the story here is, on average, we see positive returns. We don't exactly know what the ultimate outcome will be, but a change in party control is not necessarily the doom and gloom that you may see on different news channels. All in all, the market has the ability to shrug off what's happening from a political standpoint and reward, positive earnings and positive revenue growth and things like that. So with that as a bit of a backdrop, as we look back at 2020, I think we can all breathe a collective sigh of relief that we have to write a new date, a new year on any checks that we're writing. But from an investment standpoint, while it wasn't much of a year from a personal standpoint for a lot of people, it was actually a solid year from an investment standpoint. Markets were up double digits. on a year-to-date basis. And all of that came really in the second half of November and in December, as we saw positive news and continued improvements on things from a vaccination standpoint. And even saw some encouraging news yesterday on some final trials from a Johnson & Johnson vaccine that would be a single dose that would be another game changer just in terms of the ability to vaccinate a larger and larger part of the population. So a couple of things, Terry walked through a lot of this, and I just appreciate his market commentary. A couple of things that I always think are kind of wild to focus on. Talk about the S&P 500. So the 500 largest stocks in the US, up about 18 and change last year. But that masks the 77% difference in performance you saw between the best performing sector and the worst performing sector. So if you tear apart that S&P 500, the best performing stocks were, no surprise, information technology, up 43, almost 44%. The worst performing sector in the market was energy, down 33, almost 34%. It's just an absolutely massive disparity in performance between the best performing sectors and the worst performing sectors. But by and by, if you exclude energy, everything else was flat to positive. But things like tech and consumer discretionary, which is really being led by the likes of consumer discretionary would be Amazon would be driving that. Those parts of the market did phenomenally well. So how did we do? One piece that I always think is great, and I was pulled up this morning, the CAFR. So for me, when we talk about the retiree healthcare trust, this is one of the most powerful charts that we can look at. And this plots the gray line you hear, the gray shaded area is essentially starting with $105.7 million. And any change you see in this gray shaded portion is cash flow related. So the consolidation of the MERS portfolio into this trust back in the summer of 2018. And then as we've made benefit payments out of the trust, you've seen net negative cash flow over that now 2-year time period. The blue line here that moves around quite a bit is the market value of the trust. So you can see obviously the decline we saw in the first quarter of 2020, but today with a value of about 145.2 million, this to me is where it's powerful. Started with 105.4 back in April of 17. We've had net positive cash flow of about 3.3 million, but the market, so the reason we've invested these assets in stocks, bonds, cash, real estate, international stocks, emerging market stocks, is the market's given us $36.4 million in gains over that time period for a return of about 7.97%, or just shy of 8%. Now, where this is powerful is, and I just pulled it up from the CAFR, right? When we bonded for this, we put out debt with the belief that we would be able to make a better return in the markets. And the interest rate we're paying on the debt, according to the most recent CAFR, ranges from 1.16% to 4.5%. So for me, the first test of are we in a good position is this number, this 8% return we've seen since inception, if that number is at or above what we're paying from a debt standpoint, then this has been a profitable exercise. So that, to me, from a measure of health of the retiree healthcare portfolio, is a resounding positive one so far. So let's take a look at results. So absent the fourth quarter, this would have been, I think, a mixed bag for a year, but we saw strong gains really in November, and December continued that trend, although to a lesser degree. But we saw for the month, Retiree Healthcare Trust was up just shy of 4% ahead of its benchmark. For the quarter, we're starting to see a really nice turn, and we're seeing it so far here in 2021 with some of those managers that had been laggards like Sizert and Ancora. We've seen a huge shift in performance here as value-oriented stocks have started to come back into favor. So on a year-to-date basis, up 11.7%, certainly something to be proud of, thinking back to where we were in March, April, May timeframe. But a couple of things just here in the interest of time to point out, as I'd mentioned, no surprises out of anything from an index fund standpoint, but the big surprise we saw in the month and in the quarter was Sizert, and their mid-cap portfolio had a huge turn in performance. They were up 28% for the quarter versus benchmark was up 19.9. So almost 9% ahead of their benchmark for the last quarter of 2020. And starting to see that continued turn. They're about 3% ahead of their benchmark here in the month of January. So this is really starting to see patience being rewarded. Big shift in performance out of Ancora with their small cap portfolio. Again, value-oriented names here that have really been largely ignored by investors. But as we're starting to see signs of recovery from a pandemic standpoint, those stocks have done phenomenally well. International, bit of a mixed bag. The more conservatively positioned First Eagle lagged a bit, but Vontable with their growth-oriented portfolio, about 5% ahead for the year. Emerging market stocks up 18 and change. That JP Morgan portfolio was added back in November, has done quite well over that time period. And then finally, from a fixed income and real estate standpoint, absent or 2 months ago, investors would have been happy talking about fixed income returns. But now we look and say the fixed income was only up 7.4% because the equity markets were up more than double that. But Baird on the fixed income side, the more conservatively positioned part of the portfolio, continues to hold in and do very, very well. The Luma Sales Bond Fund, this was a change we made back in late October, early November, as high yield, in our view, kind of got priced to perfection. We made a shift here just to take a little bit of risk out of the portfolio and shift it into a little bit more of an opportunistic fund so they can move in and out of high yield on a more day by day and week by week basis inside of this portfolio. That's done quite well. And then finally, real estate with Prisa. So this is the real estate arm of Prudential, the life insurance company. Positive territory for the year, up about 1.1% as we've seen returns get a lot more muted, ahead of benchmark and ahead of peers. But obviously, with the lag we've seen in real estate and some of the impact there, it definitely pales in comparison to what we saw out of capital markets, right out of what we saw in the stock markets, but would expect this to be a continued source of returns going forward. So, as we look back at 2020 as a whole, I'd say it's collectively a heck of a lot better than any of us thought it would be from an investment standpoint. I would say it's better than anyone would have thought possible given how the year started. The expectations that I think 2021 is probably still going to be a pretty good year for investors as well, just based on what we've seen so far and what we're seeing from an economic growth standpoint, as well as continued improvement on things from a vaccination standpoint. So with that, I'll pause and see if there are any questions.
Thank you, Brian. I appreciate it. Does anyone have any questions, comments, or concerns for Brian? All right. Thank you, Brian. I'm make a motion to receive and file. Is there support?
Brett supports.
Thank you, Brett. All in favor? I am a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you. The motion carries. Brings us to legal. I'm going to turn it over to Tom.
Thanks. Very briefly, same comments, Open Meetings Act, virtual through the end of first quarter. Come April 1st, you need a reason. That concludes my legal report. Unless you have any specific questions, be well.
Sounds good. Thank you. I don't have any questions. Anyone have any questions for Tom? Thank you. I'm going to make a motion to receive and file. Do I have support?
Brett.
Thank you, Brett. All in favor? I am a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you. Brings us to other. I'll turn it over to Julie.
Thank you. Again, just a request that the board receive and file the variance report. And again, this is the details that support the audited numbers that were presented in the CAFR to commission and accepted by City Commission in December. And then the 5572 form, slightly different setup than the first form you saw. But according to the uniform assumptions provided by the state of Michigan, this trust is at 90.5% funded, which is on line 30. And then the all systems combined ADC governmental fund revenue is 3.7%. And basically that's due to the ARC for this system much lower than the required contribution that the pension system has. This is approximately, I think it's 1.4 million for next year. And that's a much smaller number relative to our revenue. So that's why you see that percentage on line 32 significantly lower than the pension systems. So, and you know, the reason this is so well funded is we bonded 106 million for this trust back in 2017, which was the entire unfunded level for both the employees and the police and fire, which is different from the pension system. We only sold bonds for the general employees unfunded piece because that was a closed plan. We could do that as well as this plan for the retiree healthcare is a closed plan. So we could sell bonds for that. We were not allowed to sell bonds for the police and fire piece because it is an open plan.
Sounds good. Thank you. Does anyone have any questions, comments, or concerns for Julie before we receive and file? I'm going to go ahead and make that motion to receive and file both of those as presented. Is there support?
Brett.
Thank you, Brett. All in favor? I am a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
All right, thank you. The date of the next meeting has been set already for Friday, February 19th, 2021 at 8:30 a.m. or immediately following the pension board meeting. That said, I will go ahead and make a motion to adjourn. Is there support?
Brett.
Thank you, Brett. All in favor? I am a yes. Brett?
Yes.
Monica?
Yes.
Kyle?
Yes.
Paul?
Yes.
Thank you, everyone. Meeting is adjourned at 9:14 a.m. Have a good month.
Hey, guys.
Hey.
Thanks all. Have a good weekend.
Thanks, you too.